Okay, so this video is part 2 of a series looking at the same set of transactions, and all we're doing is we're looking at how to record transactions in a template form, which, as I mentioned when I made that video, is really good for understanding the overall impact that transactions have on owner's equity. Okay, and what that mix is, right? But we don't really have a bunch of account names on there, so we can't use the template to actually post any of these business transactions to the official accounting records. In order to do that, we need to make an actual journal entry, and so that's what the focus of this video will be. All right. So we have the same scenarios we had before. Minute Maid, some kind of housekeeping service. Get it? They're maids. They work fast. Hopefully do a good job as well. And then so we have all these transactions here from April the 1st through April the 30th. All right. So A Falcon, that's not like a bird. That's like Anthony Falcon, something like that. He's going to invest some cash to start this business. So he's going to put $9,000 into the business, and he's going to get common stock. From the business's perspective, the business is getting that $9,000, and they're giving Anthony Falcon the $9,000 in common stock. So what do we want to do? We want to debit or make a left side entry to cash for $9,000. It says that he got common stock. Common stock is an equity account, and equity accounts have a natural credit balance, so that works out nicely. Common stock for $9,000. On the second, paid $2,850 for 6 months lease on van for the business. Okay, so I'm going to, this is an example of a prepaid asset. Now notice, if you're doing this like in software, these drop down boxes here, you know, and so you kind of have to get whatever answer the software wants, but I'm just telling you what it is. It's prepaid rent slash lease. So prepaid lease is probably what they had in there, and that is an asset. All right, and that's for $2,850. And of course, we know if they paid it in cash, we know that cash went down and assets go down on the right or with a credit. April the 3rd says we're going to borrow $10,000 from the bank and signed a note payable, okay, agreeing to pay it off in a year. We don't have to worry about the interest on that. We'll get to that whenever we actually pay it. So cash has gone up by $10,000. And they tell us what account to credit, note payable. Note payable, as you probably already know by now, is a liability account, and liabilities have a normal credit balance. That is to say that they go up with a credit. On the 3rd, well, we've got a few things to do here on the 3rd. It says that they purchased $5,500 worth of equipment. They paid $2,500 cash, and the remainder is due within 30 days. Okay, so they've actually included cash here for us, so we have to get our debit, which is that equipment, for $5,500. They tell us that we paid $2,500 cash, and they wrote it down for us too. That was nice of them. So that's 2,500. Asset went down. So that means that this is going to be 3,000, or the difference between 5,500 and 2,500. And so what is this? Well, I don't know what the drop-down box is going to be, but because this is due, let's see where to go. Because this is due in 30 days, what we're probably looking for here is an accounts payable. Now, the one thing I do want to say about this, especially if you were to actually have this as an assignment, is that it is equipment, and accounts payable is usually for inventories and stuff like that. But so it is going to be some kind of a payable, which is a liability. I just don't know exactly what the answer key for your textbook would want. Okay, I could look, but I haven't done that. So April the 4th, it says paid $4,300 cash for cleaning supplies. And it is a cleaning business, so supplies ought to cover it just fine. Supplies is a prepaid asset. I'm just putting this in here for our benefit. Okay, that won't be part of your answer. And then cash is the credit for $4,300. On the 7th, paid cash for advertisements to run in the newspaper. So we have, and this is another one, I have no idea what they're wanting here. I'm going to call it advertising expense. Oftentimes it seems like what they want is miscellaneous expense, something like that. So whatever it is the answer, but it is advertising expense, so that's what I'm going to write down. Expenses have a normal left side or debt balance. So we're going to go ahead and increase advertising expense with a debit to the expense. And by the way, if we had ordered this advertising on credit or on account, we would be liable for the $350. So we would still go ahead and make this same entry here. But we paid it in cash. So instead of setting up a payable, a liability, we're just going to credit cash to indicate that it has gone down. All right, keep going. April the 21st says billed customers $3,500 for services performed. All right, so when we perform services, we earn the revenue, and we didn't get it in cash, so we have to set up an accounts receivable, which gives us the right to receive that cash. So this is another asset account. And then I'm going to just guess. I know we have revenue here, and revenue has a credit balance, so it goes up on the right. Okay, and so this would be our journal entry for that. April the 23rd, it says paid $3,000 cash on account to cleaning equipment suppliers. Okay, so we paid our bill, and we did it in less than 30 days. So we set up this accounts payable with a credit for $3,000. Now we have to take it off. As we set it up on the right side, or the credit side, now we have to get rid of it on the left side, or the debit side. So this brings our balance that we owe to the suppliers to 0. And we satisfy that obligation with cash. So we will go ahead and enter that in. On the, let's see here, on the 28th, it says collected $2,300 cash from customers on their accounts. Okay, great. So cash has been collected. That means it went up. Now we set up this receivable for $3,500, but so far we've only collected $2,300. So our accounts receivable is going to go down with a credit, but not all the way down, right? We've only collected $2,300 in cash, so we still have an asset of accounts receivable for $1,200. In other words, $3,500 here minus the $2,300 here. April the 29th, paid cash for dividends. Okay, dividends has a normal debit balance. And here's the thing. We paid cash. Well, if we paid cash, whoops, started to write down paid cash. If we paid cash, cash has to go down, right? So we would at least know that the cash goes down on the right, which kind of forces us, even if we didn't know, to put the dividends here on the left. Paid this is for April the 30th, paid $1,750 cash for April wages. Okay, so we would normally set up a liability for those wages, but we didn't do that here. So we've got something like wage expense, and that is for $1,750, and we used cash. So it's going to go down over here on the right. And April the 30th, paid cash to service station for gasoline. So again, I don't know exactly what they're looking for here, but I've dealt with a lot of chart of accounts, so I'm guessing it's something like fuel expense. However, it could be automobile expense, something like that. I don't know. If you have this, you'll have enough to figure it out. So it's an expense, and that goes up with a debit balance, and then we're using cash. So that went down. Notice we don't have to do any kind of tallying of these figures, assuming that we have made these entries correctly, right? And we've made them correctly. I just don't know what the exact wording they want in the drop-down box answer thing is on some. Once we post these to the general ledger, these figures will automatically flow into the general ledger and will reconcile the balances. We'll update the balances, that's a better way to put it, on each of these accounts: cash, common stock, prepaid rent, supplies, all of these that we looked at during this exercise. Okay, all right, so that is it for the journal entry exercise. Again, doesn't help us much with so there's things that this doesn't do. It doesn't help us keep an eye on what's going on with owner's equity, not at least through the journal entry, right? And it also doesn't help keep track of account balances for things such as cash, right? It doesn't do that. We need a T account or the template for that, okay? So, but the journal entries still very, very important, because this is how our income statement, our balance sheet, statement of retained earnings, because we did have dividends here as well as some revenue, and even our statement of cash flows. This is how we get this information to those financial statements. All right.